Okay, perfect. Well, good morning, everybody. Thank you for joining in. For those of you that are here, as mentioned, if you do have questions, please raise your hand. You do have that feature enabled, and we'll dive right in. So my name's Kayla Ferking. I am the Vice President with Leader 1031. My contact information is up here if you do have questions for after the class that you maybe have that aha moment. Wait, I forgot to ask. And at the end of this session, of course, we will be open for questions. And throughout, just raise your hand. So I work for Leader 1031. Qualified intermediaries are operational sometimes in certain states and regulated by different escrow title companies. We are bank owned and operated, which gives us the ability to function off all 50 states. So that brings me into a statement and questions that I have to start out with. And I always forget this part, but number one, we do not give legal tax advice. So if you do have a client asking for legal tax advice, please have them consult their CPA. I've been in the real estate industry for over 14 years, born and raised in Southern California. I've been with a qualified intermediary for over 9 years now. Gosh, I'm like, it seems like longer, but I've done thousands of transactions in 1031 space. I come from a family of real estate investors and background. Graduated from Arizona State University. Go Devils. We were crushing it. If anyone went to ASU here, we're doing awesome this year. And I also went to FINM. So I had this passion of interior design and combined that with real estate licenses in different states, investments, and then that catapulted me into this niche space of 1031. I've been with Leader 1031 for 3 full years now, which is crazy. Again, I feel like time just goes by so quickly. So it's been a win here. Great, phenomenal company. I'm very happy, and I like making my clients and friends happy as well, including you guys. So talking about 1031 as we dive in, does anybody know what IRC stands for? And please feel free, plug it in the chat, raise your hand, because this is kind of an interactive. I like to read the room, if you will, or read the Zoom room. Give it a sec. So IRC is Internal Revenue Code, right? So that's what we're focusing today is 1031-1031 is an Internal Revenue Code, right? So IRC section 1031. So it's a section of what? The tax code provision created by the IRS. Now, does anyone know when IRC section 1031 was added as a tax code? No takers here. Okay. It was actually added in 1921. So it's been around for quite a while. It had different numbers and figures, different 202, I think it was 202C, and we'll get into the history of exchanges, but really looking at that since 1921 for your talking points with your clients, that's a long time for a tax code provision to be around. And obviously there's been restrictions and regulations that have limited use of IRC section 1031 that are advantageous specifically to investors. The exchange period, we talk about this a lot in my world. Does anyone know when that ends? You know, we're all about restrictiveness and timelines. Has anyone heard about the certain numbers that correlate to dates on limiting you in an exchange? Check the chat too. Okay, no one in the chat yet. That's okay. All right, so that's 180 calendar days. 180 days is the entire exchange period to complete an exchange. That means sell the relinquished property and acquire the replacement property. Those are an introduction of 2 terms here for those of you who are not familiar at all with 1031. So the relinquished property is the property being sold, the replacement property is the property being acquired. And last but not least, what is the maximum amount of capital gains taxes you can defer? So this one, I'm going to dive in quickly here, is a trick question. So you have no limit on the amount of capital gains taxes you can defer. There was a proposal in Biden's family tax plan to cap that. Obviously, we are past that presidency into a different presidency, and during the Biden administration, that never formally passed. So there is no cap on the value of capital gain that you can defer. Meaning if you bought a home for 500 grand and you're going to sell it for 700, you have gain of 200. You can do that exchange. Let's say you bought a hotel for $3 million and now you're exchanging it at $23 million. That's 20 million in gain. You can absolutely exchange that as well. So meaning there's no cap on the amount that you can defer capital gains taxes on. So you can keep rolling those investments into more real estate. So a 1031 exchange is the sale of one investment property or more, followed by the purchase of another investment property, facilitated by the qualified intermediary, also known as the exchange company, in the middle. Okay, so that's us. We're the QI or accommodator, facilitator. I'm sure you've heard those terms used commonly for 1031 individuals. On the top of your screen, while it's small, it's derivative from the tax code directly. It states no gain or loss shall be recognized on the exchange of real property held for. So let's tackle that. Real property means specifically real estate, right? We all have our real estate license. So we know that it can be real estate. It needs to be held for, meaning it cannot be held for a short amount of time. Held for in the 1031 world is a longer period of time, typically around a year and a day. Minimum up to 2 years holding is a more conservative timeline before a client can exchange. And that next line here is for productive use in a trade or business or for investment. So we know strictly it has to be an investment property. Now it needs to be exchanged solely for property of like kind. So again, real property held for investment, in productive use, trade, or for business purposes. Now, when we analyze who actually is looking at doing the exchange, they're delaying that recognition of capital gains taxes. This doesn't mean it's completely wiped away. If an exchanger eventually sells a property after doing a series of exchanges or one exchange, we call that they're liquidating, right? They're cashing out. If they're to do that, then they're facing a taxable event on the capital gains taxes all the way back to their original purchase price, known as their basis. So the goal is to keep delaying that recognition. We keep rolling it, diversifying, consolidating, however our investor portfolio looks, what's advantageous to them at the time of their asset in question and what's being exchanged. So a brief history of 1031 exchanges. So when you're speaking to clients, you're aware of what makes sense and the why, because we have a lot of clients sometimes, or what makes sense with the 1031 and why did we get here? How did we get here? So in 1918, right, we had Congress adopting federal taxes and disposition of properties. And in 1921, we started focusing on what was the original 202C of 1031, which was selling investment property or securities and understanding that I want to retain my gain. I don't want to take a huge hit on that and be taxed on capital gains category. That catapulted into different timelines, the Revenue Act of 1924. And then we saw the little number of 202C flip into 112B1, and then eventually turned into 1031. So it's been there all along in existence from about 1921, as we mentioned, and then we're seeing it change quite a few times. Now, between 28 and 84, one main thing happened that I like to hit on, obviously the change in the number, but additionally in 1984, we saw the restrictive timelines, 45 calendar days to identify, plus an additional 135 calendar days to close, totaling that exchange period of 180 days. So we had that restriction, which was very interesting. And the reason why we got there is a gentleman named Starker. Okay, so TJ Starker in 67 decided to sell his land, and in selling his land, attached to it was a bunch of timber. So he was selling the logs, right, for production, for real estate development, and he also owned the land. And when he sold this land to a gentleman named Zellerbach, they decided, well, don't give me any money, Mr. Zellerbach. We'll have an agreement. You can acquire the land. And what we'll do is have you, based on fair market value of the land, eventually buy me equal or greater value of different properties. So there was never money actually exchanged between parties, which would trigger taxable events. Okay. So in this scenario, TJ Starker created this new aha moment in this structure of saying, well, I want to go ahead and use the exchange proceeds towards new replacement properties, right? So that's in fact what was done. It actually took 5 full calendar years to buy replacement property, which then introduced this 1984 component of restricting the timelines. The IRS said, absolutely not, you cannot wait 5 full years. Obviously, we have economic shifts in a couple years. In 5, you could be buying low, selling high, which is, advantageous. But that's why we see the restriction from the IRS. In addition to that, in 84, there were interests in partnerships that were ineligible for recognition treatment to be exchanged, meaning I cannot exchange into or out of a partnership. The partnership as an entity can do an exchange. However, I cannot sell my interest in my partnership to someone else. I'm going to exchange it to someone else. That's disallowed in a 1031 exchange. Now we did some history, right? I want to talk a little bit more about one more bullet point on how we connect the differences of traditional sale and understanding the 1031 for talking to clients. The traditional sale, the taxpayer sells real property and receives money, right? That creates a taxable event. We don't want to do that in our world with investors. So in the 1031 world, what we're focusing on is selling real property and acquiring more real property held for investment. It's that simple. So traditional is real estate for cash. Exchange is real estate for real estate, thereby eliminating or deferring the capital gains taxes and eliminating that taxable event, right? So deferring taxes or having the taxable event in traditional. Now, in my humble opinion, this is the last and greatest tax code available to real estate investors in our tax code provision. We've had a lot of things that have been sliced and diced away from us. This one does allow that advantage of maybe the little guy who bought something for 50 grand and it appreciated to 100 and got to exchange that and use that as a chunk down payment for something else, right? To grow and grow as an American in exchange. There's also, as I mentioned early on, that hotel example, the advantage of having a large asset and maybe selling it and diversifying, buying several different properties with those proceeds. So it allows freedom to roam about the cabin, if you will, in the United States of exchanging different assets for one another. Who do we look at? Who's exchanging? I really hit the nail on the head with investors, right? We know that. So they're maxed out on depreciation. Maybe they sold their property, they've done a full max out on depreciation, and they want to buy something greater. That gives them a little bit more cushion of some more depreciation. And maybe they have a higher return, right, on their investment for maybe rental income on that new property. Maybe they have co-owner problems, right? That happens a lot. Sometimes people go into partnerships with that I mentioned that you cannot exchange into or out of the partnership and they struggle. So the partnership needs to do the exchange. Or they're tenants in common on title, which is the most ideal structure of ownership if there is a business partner in a 1031 exchange, so that when that property is sold, both can go separate ways because you're owning 50% of an undivided interest of property, right? So it allows you to separate and move on. Tired of being a landlord. It's a big one. So today I'm going to talk about a few alternatives at the very tail end of this presentation and how to land that listing and get those investors off the fence. Relocation to another geographic area. I mean, we've seen this over the course of the United States being a country, right? But more frequently in our lifespan during COVID, people moving assets to different states. Leveraging tax deferral benefits, more cash available. As I mentioned, the $50,000 guy who maybe got 100. Maybe he exchanged that and used 2 down payments. Improving cash flow. Something isn't performing, move it to a different geographic area. Of course, diversification, as I covered, and consolidation, meaning you can sell multiple investment properties, combine the proceeds, and buy one large asset. It's almost like theoretically looking at your lifespan in your 20s and 30s and even 40s, sometimes 50s, right? We're diversifying, getting all these investments growing and growing. And then later in life, when we want to retire, call it 60s, 70s, we want to consolidate those. So using this tool on the front end to the back end of our life cycle is pretty amazing. And yeah, I just said life cycle, pretty morbid. So pretty neat though to use those tools. depending on what stage of life your client's in. So covering pitfalls, we have 9 different pitfalls that corresponds to that handout that you have. There is a link in that chat if you do not have access to it immediately. It's literally the same exact pitfalls. In these slides, I'm going to cover more in-depth detail, of course, with different examples. And I know this is also recording, so you can reference it as well. So number 1 pitfall to avoid, right? These are things that let's eliminate this from our knowledge base. It's only 9 takeaways completely that you need to know about the exchange world. Do not ever close escrow on the sale of the relinquished property without setting up a 1031 exchange first. You cannot go back in time, of course, and set up the exchange after close of escrow. And the common pushback there is, well, the proceeds are still sitting with escrow. It doesn't matter. The recording has already been completed and the burdens and benefits have now transferred to the new buyers, and they are owners of that real property paying property taxes, right? So what do we do in those situations, right? Stop the closing, talk to escrow, hopefully coordinate if you're working with a selling exchanger, talk to the buyers, see if we can postpone. It typically takes us about 20 minutes once we have all docs to set up an exchange in a segregated account. And what we mean by setting up an exchange, you guys have your RPA, right? Your residential purchase agreement, or PSA, purchase sales agreement, whichever acronym you want to use for that. When we're setting ours up, we have our EA, an exchange agreement. The exchange agreement comes with an assignment, and that assignment needs to include a cooperation clause that's also signed off by the other party in the transaction. It looks something like this. The buyer is aware that the seller intends to perform an IRC Section 1031 tax deferred exchange. Seller requests buyer's cooperation in such an exchange and agrees to hold buyer harmless from any and all claims, costs, liabilities, or delays in time resulting from such an exchange. Buyer agrees to an assignment of this contract to Leader 1031 as a qualified intermediary by the seller, right? So we've seen it small, maybe in a sentence term, seller to perform 1031 exchange at no cost to buyer. So part of our assignment encompasses this literature, a little bit more legal terminology within that assignment, but we need to have that in place prior to close. We also need to coordinate with escrow so that the settlement statement, is arranged accordingly to benefit the taxpayer doing the 1031 exchange. I just switched slides very quickly there. I don't know if you caught it, but this is now the replacement side. When you're making offers for clients on the replacement property, right? The seller is aware, because now you're working with an exchange buyer. The seller is aware that the buyer intends to perform a 1031 exchange, right? At no cost to that seller, because the buyer is exchanging. So it's good to have this in offers. You also have your SIE through zip forms, right? Sellers intend to exchange. So there's different forms you can access. At the very least, you can have an addendum, right? That includes it in here if you forgot to check mark box. Again, good to have it. We will have it in the assignment regardless. Excuse me. So the timeline of the exchange and when we are involved. I know that's a common question. When do I get you involved with my clients? Depends. Sometimes QIs get involved with exchange clients a year in advance. I have a pipeline that's out about 2 to 3 years long. Sometimes they're commercial deals. So if there's a client that needs to talk about entities, ownerships, understanding how their partnership is working in favor or against them, understanding how to tee it up for success with their end game, that's when we have a discussion. But when can we actually set up an exchange? Well, let's say you list a property for sale. That's with your seller. That's our exchanger. As soon as an offer comes in and there's a fully executed RPA, we now open escrow. We are contacted at that moment to actually set up the exchange documentation. We cannot effectively set up an exchange agreement or assignment until we have escrow instructions, a prelim or pulled deed, and that contract. So we need those 3 items in order to do so. Now the exchanger taxpayer goes through their entire contract with you, their contingency removal, inspection day 17, loan removal, contingency 21, and now let's say they have a 30-day escrow. The sale proceeds are wired from the buyer into that escrow account. After closing, the proceeds are wired directly into a segregated bank account that the qualified intermediary holds on behalf of their exchanger. You help them find replacement property because the clock starts ticking. If you look at the bottom of our screen here, on day 1, which is day 0 is the recording date, your close of escrow date. So day 1 starts ticking where they have 45 calendar days to identify replacement property and an additional 135 days to close on only the properties they've ID'd. And when they do so, let's say you make an offer on replacement property. You need an EMD, an earnest money deposit. We wire those funds over from that segregated account. Of course, there's red tape behind that, disbursement forms to be signed, and coordination and approval of wire instructions with escrow. Off the money goes, and we've direct deeded title back to the exchanger. So in this structure here, the only difference from the traditional sale of just selling, pocketing, and buying is selling, funds go to the exchanger, and then buying to the new escrow, and then eventually that seller that they're buying from. So we're just adding this extra component here of the QI, or qualified intermediary, to hold those proceeds. Do we have any questions at this point on our first pitfall? Okay, I have the chat open too, so if anything does come up. Timeline requirements, they had that 45-day identification period. This stops strictly at midnight. Okay, so if there's a property that pops up on day 44 and that's the one, and they want to ID that property, they absolutely can ID it on the 44th day. There's no rule that says they need to use the entire exchange timeline, but it is available because, as we know, every weekend and sometimes midweek randomly, there will be new properties listed for sale that may be that goal for your client. So on the 45-day ID, they have an option to use the most commonly used rule, which is the 3 property rule. And by identifying 3 properties, they must have them in writing and unambiguously describe those properties. What that means is 123 Main Street, right? An address or an assessor's parcel number. So if they identify up to 3 replacement properties, which is typed into our form and they sign it, so we're holding it on file for them, right? When they're looking at that 3 property rule, what they're doing there is saying, I may buy one of these 3. They also have the option to buy all 3 or 2. I'm bringing up the 3 property rule. It was asked last time I did this class a couple times. So you have the option to allow more properties on that ID, and there's pros and cons here. If you do ID 3 and you're past day 45, and let's say you're now on day 70 of your timeline of 180, and you cannot close on any of those properties, that means your intent was still to buy one of the 3 or all of the 3, because the goal is to spend all the cash or acquire all properties identified, either one. So if you cannot do either, the IRS forces our hand as a qualified intermediary to hold those funds until day 181. So they're released after the expiration of the exchange period. Now on the pro side, if you ID 3 properties, and let's say you sell for $1 million and you're buying for $1 million, about there, you identify 3 properties valued at $1 million and you close on the first one. You now have a completed exchange because you've spent all the money in your exchange. That was one of the 2 rules: spend all the money or acquire all properties ID'd. So you're now completing a perfect storm 1031 exchange if you do effectively close on one of the properties and spend all the cash in that scenario. So again, being careful with what we ID. So pitfall number 2, as we roll into the next one out of 9, is not understanding the requirements for full tax deferral and partial exchanges. I'm going to cover a visual equation here, but I wanted to start out with understanding the 2 rules for value of what we're replacing. Clients will come to you and ask, well, I'm selling for this, what do I need to buy? And a very common misconception is, well, I'm selling for $1 million and my loan is 500 grand. So that means you're 50% leverage, right? So that means 500 grand is already gone. It's being passed to the bank, right, to pay off the loan. That leaves, let's say there's no closing costs, $500K of net proceeds in the exchange. However, IRC 1031 states the value of real estate is net plus debt. So my debt was 500, my net is 500, that's $1 million. just because the loan is paid off through the sale doesn't mean that you don't have to replace it on a purchase. So our rules here are reinvest the net proceeds and have the same or greater amount of debt on replacement property. So net plus debt equals the value of what our exchanger needs to purchase for full tax deferral. Now, if that person in my example goes down in value, we have a little bit of an issue, right? And we'll look at that on the next screen here is an example. We know again, reinvest net exchange proceeds and acquire a property with the same or greater debt. So in this example, someone sold a property for $900K. Their loan payoff was $300K, and the cost of sale, we'll call that closing cost. That is your commission. That is the buyer's agent commission. That is title, transfer, recording, escrow. All of those are going to be on that $60K line item for cost of sale. So when we take the 900 minus the loan payoff of 300 minus closing costs, we're left with net equity of $540,000 that's available in that segregated exchange account. So that's the only amount of cash that we would be holding in the exchange after closing. Now you help them find a new property and they want to buy this beautiful property. You found them at $1.2 million. So they're going up in value. Now they talk to their amazing lender and they get approved for $660,000. We have the 540. Hey, Kayla, can you wire over the 540? Absolutely. Hey, Mr. Lender, can you wire over the 660? Absolutely. That gets us to that list purchase price of $1.2 million. In this situation, this client has what we call boot in the amount of 0. So boot is anything that is non-like kind property. Obviously, cash is not property. Obviously, mortgage replacement is not property. So boot can come in the form of not replacing the value on the replacement property. Here's another example of what boot would look like if you found the same client a $700,000 property. Now, right off the bat, I would go 900 minus 700, that's $200,000 boot. But again, that's not true because we're not looking at the value of what they sold. Remember the net plus debt. So going back through the equation again, you're looking at a settlement statement and you see sales price, right? You look at all the line items for everything going down. The loan payoff is $300,000. All the commissions equate to $60K plus transfer, escrow, tax recording, title. Now, the net equity, we know 540 is going to the qualified intermediary. This means a reduction of $60K from 900. The only component that isn't value are commissions. Those are expenses, right? Our escrow, title, all that. Our closing costs reduce the value of real property. While we know as realtors and real estate affiliates, it's baked into the list price, right? So at $900,000, I know the closing cost will be $60,000. That means this person needs to find a property for at least $840. Well, what I'm doing there in a backwards format is looking at the net 540 plus the debt 300. That gets me to $840,000. Instead, this person decided to take that remaining $140K combination of boot. So they talked to their lender and they said, you know what? I'm going to reduce my mortgage by $40,000. We call this mortgage boot. So they still owe capital gains taxes of $40,000 on mortgage boot. Even though the loan doesn't exist of the $40K, they reduced it by that much. So they're not abiding by the two principles up top, reinvesting net proceeds and acquiring property with the same or greater debt. They went down by 40. They also said, hey, Kayla, let's wire over only 440, leaving 100 grand left in that exchange account that I will take after closing of my only identified replacement property. We went ahead and did that. So now they're getting 100 grand cash in their pocket. They eliminated 40K from mortgage boot. And what they're responsible for paying capital gains on is 140. So here they did a partial 1031 exchange. This is very advantageous for a lot of our clients right now. People want some liquidity on hand. Sometimes when rates are a little bit more friendly, but I think we're all adjusting right now. We're seeing a little bit more action with real estate, maybe leveraging this higher to that $1.2 million purchase. But sometimes we see this where people want some cash on hand and also the benefit to do a partial exchange into more real property. So you're getting best of both worlds here. 1 second, I'm frozen. All right, like kind. Sorry, I went fast here. Like kind, going back. Just like skipping over that one, but we're not skipping over pitfall number 3. Here we go. Is selling or exchanging into a property that is not held for investment or used in a trade or business. Okay, so you cannot exchange the following. You cannot exchange your primary residence. Absolutely not. That is not an option. That falls under Internal Revenue Code section 121. There are exemptions for that, right? Single filers get an exemption on their primary sale of $250K. Married filers up to $500K. You cannot exchange stocks, bonds, notes, interest in a partnership, as we covered, or inventory, dealer property, we call them flips, right? REITs, real estate investment trusts. None of these are exchangeable for one another. They're not qualifying exchangeable properties. Now, qualifying real property is any relinquished property held for that productive use, trade, or business. And what does that look like? How broad are like-kind properties? Maybe you have a client that owns commercial real estate and they want to exchange into a tenancy in common, a fraction of a different building that's maybe an office space. They want to sell that office space and exchange into agricultural land. Maybe they exchange land into a vacation rental. The vacation rental into oil rights, mineral rights, wind turbines are exchangeable. Duplex, triplex, right? Fourplex, all of these can be exchanged across the board. Here's the other misconception about like kind. Oh, well, I sold for a condo, I need to buy a condo. Absolutely not. You can sell a condo and buy any one of these in front of you. Again, so long as it's not your primary residence or any of those other items that are really tangible personal property items. Questions on like kind before I move forward? So we understand when we're, when you're talking to your client and they maybe have an idea of what they want to buy, or you're at a listing appointment, let's say, and they don't really want to sell their property, but your goal is to talk them into that one, but also coach them on why it's advantageous. What's the return going to be, their highest and best? Maybe their dreams are what's ahead. Maybe they want to buy a duplex. Maybe they want to buy a vacation rental that they can get some use out of and use it for Airbnb or something, right? So you have these opportunities in front of you that you don't just have to go across the board from the same investment to the same investment class. The pitfall number 4 is using a person who is considered disqualified as an intermediary. So you cannot have a family member, an employee, or realtor, real estate professional, or legal advisor, attorney act as their qualified intermediary if they've, especially legal tax advisor, if they've been supporting them for the last 2 years. Okay, so when we look at qualified intermediary, is defined as a non-disqualified agent to the taxpayer. So non and dis. They are not disqualified and non-disqualified, so they're qualified intermediary holding right in between two transactions. I'm in the middle. So we covered the written agreement, understanding that there is that EA exchange agreement, transferring that relinquished property to acquire the replacement property from a seller, and then transferring that the replacement property back to the taxpayer. So our goal is a matter of fact of direct deeding and holding sale proceeds. So I like to say sometimes that I'm the middleman in a transaction. My business is really holding sale proceeds under safe harbor regulations of our tax code in between two real estate transactions. So very being up to speed with different regs within our tax code provision system. So just a straight list if anyone's want to take a picture. I know it's recorded as well, but Who is disqualified if you talk to someone and they say, oh, well, why can't you be my QI? Because they legally cannot. These are all disqualified to act as a qualified intermediary. So not only are we preparing that EA, the assignment, we also have that notice that, of course, the other transaction party needs to sign. We include detailed closing instructions, notating changes that need to be made on the settlement statement and transfer of funds. So we're coordinating and making sure that that settlement statement is dialed with title and escrow. Sometimes it takes a few back and forth, as we know. Even with escrow, they have their hands full. They have a large job and transactions to make sure everything is checks and balances on that settlement statement. And disbursements are going out to all receiving and deserving parties in the transaction. So we are also on that ALTA. So you'll see on the top of the settlement statement, it'll say something like Leader 1031 acting as qualified intermediary on behalf of John Smith. So this literature changes for who the actual seller taxpayer is. So that's another reason why we need to stop that closing if your client does intend to set up that exchange at last minute. There are different levels of qualified intermediaries, so do your due diligence when asking QIs or interviewing them. We have what's called the Federation of Exchange Accommodators, right? So that's kind of a not necessarily a governing body, but a stamp of approval, because qualified intermediaries are non-regulated on the federal level, okay? So make sure you ask those questions. Are you part of the FEA? You can always Google the FEA and see who's part of that system. Some QIs are backed by the FDIC because they're a bank. So Leader 1031, we are bank owned and operated. This means, right, we're technically regulated on the federal level. So bringing these points up so that you can ask these questions and let your client know, whoever they're talking to, ask where the money's going. What bank is it going into? Sometimes smaller QIs will go ahead and spread a lot of the cash proceeds between several banks who our clients are not favorable with. When you're with a specific bank, it's clearly with a specific bank. So make sure you ask those tough questions and do your due diligence as a realtor to verify those proceeds so you're offering safe and secure referrals. Pitfall number 5. I'm going faster, I think, because no one's asking questions, so it'll be a quick one. Number 5, not consulting with a CPA tax advisor before closing on the sale of the relinquished property. While of course we can pause the closing, hopefully with willing parties, sometimes we have a taxpayer that isn't really set up for success in a 1031 exchange, meaning maybe they lived in the property 2 months ago and rented it out and never told anyone. And now they want to do an exchange, which we know that as your primary, that would not in fact be an investment property. That would not fulfill the need, but we don't file their taxes. Maybe they're withholding that information. Again, we will facilitate the exchange, but it's always beneficial to communicate with their CPA. We don't know how the CPA is filing their taxes. A lot of the time, this question, whenever I have clients on my East Coast states that are operating in LLCs, which is majority of the properties out there, if there's an investment in an LLC, we'll ask them, are you regarded or disregarded? And they have no idea what that means, which is something filing its own tax return or isn't it? So we need to set up segregated accounts as a bank owned and operated QI that correlate to that taxpayer ID. And guess what? So does your client when they're filing their taxes. We collect what's called a W-9. And if they don't talk to their CPA and understand, hey, wait, do I have enough gain? How much did I depreciate on this over time? Does this make sense to do a 1031 exchange? Again, this is not one size fits all. Every single transaction, every single person on this call right now has a different income. Obviously 1099s, everything we live for, but all of our investments are going to be different and all of our assets are going to perform differently. So it's always good to be in the know and connected with the CPA. And if they file their own taxes, then they need to be dialed and answering those questions. Because we do not steer them again in the legal tax advice category. Pitfall number 6 is not handling the partnership LLC issues properly, right? So the entity that sells in a 1031 exchange needs to be the entity that acquires. So if Kayla Firking sells a property as an individual, that means it's my social security number. So I can buy as Kayla Firking as an individual. Now, if I'm Kayla Firking and Trevor Firking, my husband and I married filing joint, and we're married filing joint in the United States, then it would be his social security number, right, on the tax returns, and we're doing the exchange. The only switch up I can make in that is when people, this comes up with trust. Well, can I buy in my revocable trust, but I sold in my name? Absolutely. Disregarded and regarded. A disregarded entity means, in the word itself, it's disregarded. It's irrelevant. We don't care, right? So Kayla and Trevor Firking are selling as husband and wife, but we're acquiring in the Firking family trust. Okay. It's revocable. Revocable means it's just passing through to our Social Security. So it's the same process. Those partnership issues that I talked about early on, when someone has an LLC that's selling and maybe there's 5 members and they're all 20% vested in that LLC, and one of them doesn't want to exchange, they want to cash out. We have an issue there because the entire LLC needs to do the exchange. In an LLC, if you liquidate with a regarded LLC, so a portion of cash is taken and funneled through the LLC's bank account, it's dispersed to all members and taxed. So there are some issues that we like to get ahead of, and understanding when you're pulling title or talking to your title rep, how are they on title? How are we going to be signing? And as you know, it's really nice to get ahead of that rather than go back and revise all the contracts at the end of the transaction, and maybe even pause it. I mentioned tenants in common early on. That's typically the best case scenario of how you can buy and sell investment property with business partners. I mentioned that 5 partners were in that LLC at 20% each. If there were 5 business partners, not LLC member partners, just we're in business together, at 20% tenants in common on title, when we sell that property, I can take my 20% in exchange to wherever I want. I'm not stuck with that group in the LLC. So it's good to ask the question, is the LLC regarded or disregarded? Again, regarded, it files its own tax return. It receives a 1065 tax form. Disregarded, right? It's irrelevant. It's probably the person's social security number. It's a sole member LLC, and it receives a 1040. So I ask those questions, but if you see an LLC and you get a little anxious, always feel free to call me. We can talk through it. We can get the client on the phone and hopefully their CPA to explain a little bit more about how that tax return is filed. I think I dove into this on the last slide. I know that there are issues, again, with the husband and wife I'll talk about before I move on briefly here. If Kayla Franklin is my maiden name, if Kayla Franklin sold as an individual and got married midstream, and now I wanted to buy with my husband, I could do so, but I need to prove the track record that my husband's been paying property taxes and we are filing under his social on the sale. Right? The entity tax paying, if we switch it midstream, I'm now potentially property tax basis shifting. I'm giving an advantage to this new social security number who's getting tax deferment, and I'm off the hook. So it will raise a red flag with the IRS. Just always keeping a paper trail, remembering if you do have a taxpayer that a lot of the time say, oh, I want to sell and buy this for my son. Okay, well, you can buy it for your son, but you need to remain on title. That's how you get the tax deferral benefit. The son can live there and pay fair market value rent, of course. Any questions on entities? Okay. Pitfall number 7 is not evaluating the entire exchange transaction on both sides of the exchange. So we talked about the value. We understand value, right? The $900,000 example. Always getting ahead of that timeline of the 45-day ID, talking to your client about where they want to go so that you can set up this domino effect of the relinquished property closing first, so that there's liquidity, there's cash available to purchase the replacement property within that restrictive timeline. Sometimes we get last minute exchange that happens, people decide and they change their mind, and then they decide and change their mind, and we're at the end of our rope and they're closing escrow today, and we set up an exchange, and now they have 45 calendar days to scramble, and that puts a lot of weight on your shoulders to find them replacement property. If that's the situation, of course, we know the timelines. However, if you're at the listing appointment and they say, oh, well, I want to sell in Dana Point and I want to buy in Huntington Beach, and that's their plan, you can now narrow down your farming market or where you farmed and maybe get them into one of a pocket listing that you have or with a connection with another listing agent, whatever it may be. You can get ahead of the game in that area to start generating some good feelers of replacement property. So you're not stuck with just a month and a half of finding a replacement property and that's all you have. Now, if you do not formally ID, if the client doesn't formally ID within 45 calendar days, the cash we're holding is transferred back to them on day 46 and it's a blown exchange. So understanding those timelines and evaluating where we're going. It's nice and neat when the listing goes, it's smooth, let's hope, right? Not all of them do. But when everything goes well with the listing and then the escrow, everything's beautiful, nice, neat bow, it's fantastic. But the anxiety from that transaction doesn't just end, it'll start again if you're not ahead of it looking for that replacement property. So being aware with your client, let's set you up for success, and now you're double ending the deal, which is fantastic. The exchange expenses, that's $60,000, and this is part of that value of looking at what we're buying, right? The 900 minus the 60 in closing costs minus the 300 in debt. When we're looking at that scenario, what is classified as an exchange expense and what can we use the exchange proceeds for on the purchase for closing costs? Of course, broker commissions, exchange fees, transfer taxes, escrow fees, recording fees, title insurance fees for the owner's policy. Okay, so when they're buying, of course, attorney or escrow fees incurred in connection with the sale or purchase of the property. Repairs. Well, I repaired my property on my relinquished sale, and now I put 20K into my property, and now I sold it for 50,000 more. I want my 20K out. If they touch that money, that's boot. Their 20K will be taxable. And when we look at that, what are they taxed at specifically? Capital gains taxes include 4 different levels or components, if you will. The first one is depreciation recapture tax. The depreciation recapture tax is 25%. So let's say they depreciated $100,000 of their property over the course of ownership. They're paying $25,000 in taxes. The next one is net investment income tax, NIIT. That is healthcare, Obamacare tax. That's 3.8%. That is across the board for capital gains taxes for Americans. So now we have those two. The federal capital gains tax, that component is either 15% for lower earners, 20% for the very high earners and up. And the applicable state tax, I have 0 to 13.3 here. We know some states for income and capital gain are 0, and we're looking at California at 13.3, the highest in the country. So this is very advantageous for where we live in Southern California. Massachusetts I put up here since our headquarters are there, but in addition, I wanted you to be aware of how other states typically are. They're usually around the 5% threshold. So we're a lot higher there. And doing the exchange, all of these capital gains tax components applied to that gain number, if they were to do a traditional sale, are around about 35 to 42%. And it depends on all of these individual factors, right? Every person's going to be different and their CPA will tell them exactly what that number is. So obviously going to be higher, and this gives them a little bit more of a reason to keep exchanging. So this was a neat one I wanted to touch on just for our areas in SoCal. If a client is living or a seller owns a fourplex and they're living in one, you'll see the number 121. That's your primary exemption. You're living there, you still get to apply that exemption. Let's say you're a single filer at $250,000 exemption on gain. So you get to use that when you sell this property. So there's one buyer that comes in, you use your exemption on the first 250, and then the other 3, when we do the calculation of price per square foot, we can do the math here, you can do a 1031 exchange on. This same concept applies if you have a write-off of your office, an Airbnb room, a rented room in your home. As long as you're documenting it, that it's used for business in your home, you can exchange a portion upon sale and use the exemption on the other one. very commonly used with zoned R2 properties. Obviously you have the ADU that's a rental, and then you live in the primary, and we do the math with the CPA based on getting their advice on how much they're deferring in the exemption. They're getting exempt on the 121 primary, and then they're deferring in the 1031 portion. So pretty neat to do this. Obviously, same principle for duplex. Another creative one for setting up for success and knowing both sides, right, is following Revenue Procedure 2008-16. This is the vacation rental option. Second homes are non-exchangeable. A second home is defined as personal use, okay? And a vacation rental is as such. Vacationers will rent it, right? So I had a client yesterday asking me, well, what's the difference? I'm like, well, we break it down, right? My second home is mine. It's in my space, no one else's. That vacation rental they can use to an extent. Now, this revenue procedure was created in 2008 that limits the use. Of course, the IRS created it. So we're looking at it post-exchange. We call it the 222 rule. So let's say they did a 1031 exchange. They bought a property in Mammoth, okay? And they're renting it out. The rules are they have to own it for a minimum of 2 full calendar years. Here's your first 2. Followed by a minimum rental to a third party for 2 weeks each individual year. Then they can use it for 2 weeks each individual year. Or they can use it up to 10% of the time it's rented each individual year. So 222, own for 2 years, rent for a minimum of 2 weeks, you get to use it for 2 weeks. After the 2-year marker is up, this person can claim it as their second home. They can claim it as their primary residence and move into that property. Yes, you heard that right. So in a 1031 exchange, you can move into your replacement property so long as you hold it for 24 months, right? So for 2 full tax filing years. But this is a really neat principle for people who want to do an exchange into property that maybe they had a long-term tenant and they want to get some fun use out of that property themselves. Another creative alternative before we wrap up here is the Delaware Statutory Trust. Now, I'm bringing this up, a lot of questions, you'll see it if you type in 1031, and that's because, into Google, and that's because a lot of these sponsors will piggyback off 1031 tax code. They are not qualified intermediaries, but they do facilitate a very incredible product that's called Delaware Statutory Trust. Why DST? Why Delaware? It was created in Delaware. It could have been California, right? But this revenue procedure is 2004-86. This means it was created in 2004. It was the 86 one created that year. And DST is an alternative investment. So imagine a skyrise building in a metropolitan area near you, right? We'll say downtown LA. So if we look in Los Angeles and we see these skyrise buildings and maybe they're going for $100 million. I can't buy that outright. Maybe one of you can, but let's say all of us can't outright buy that, but we're all accredited investors, right? So we can put in a minimum investment of $100,000, or our net worth less our primary residence is over $1 million. So now when we're looking at this, I can go in and say, hey, wait, I have $1 million from my exchange. I want to buy a fraction of that building. We call that a beneficial interest or a fractional ownership, but it's a beneficial interest in that building of $1 million. There are other accredited investors within that building that also own their little pieces of the pie. Now, these are desirable to a lot of our investors that want to get out of being landlords, that maybe aren't getting off the fence so easy about listing their property. They don't want to go back into being a landlord in another property, so why sell? They know what's comfortable in front of them. This is passive income, right? So they do not manage the property. It allows them diversification. They receive monthly income distributions from the tenants, in that building. Now, I mentioned the word sponsor. A sponsor, imagine, is a company that's multi-million dollar worth, hundreds of millions, and they go out, they acquire land, they build a building, and they offer part of it for sale to accredited investors to buy a portion of it. That's how this process works. The only people who can effectively present an offering to an accredited investor has to have a securities license, okay? You cannot receive commissions on this as a realtor unless you have a securities license. Okay, so when we're looking at these, you would partner with what we call as a registered representative. Just like us or you have a broker. They have broker dealers that manage different registered representatives. So think your broker, realtor, their broker dealer, registered representative that offer this type of product that acts both as real estate and as a security. So it's a really nice opportunity for these clients to sell, get passive income, relax, not have to manage anything, and they didn't pay a dime in capital gains taxes. When we keep exchanging over time, we have this morbid term that we call you swap till you drop. So you exchange until you die. Let's say you did a 1031 exchange into this, and my family owns a few of these. My parents own a few of these, I should say. And their plan is when they pass away, your beneficiaries get a step up in basis. So effectively, my brother and I will inherit this building, let's say, and the capital gains taxes go away. Now, I don't know about you, I'd rather have mom and dad, but the building is a great way to go ahead and use the exchange proceeds over time and keep kicking the can down the road, and you're getting your rental income. And when you die, your beneficiaries inherit it. You never paid the capital gains taxes, and I can go and sell that piece of the DST once it's gone full cycle, meaning when the building sponsor is ready to sell it, then I can exchange again or I can cash out. So this is a very, very neat principle for DSTs. They aren't just office buildings like this. They are industrial, multifamily, student housing, oil, minerals. There's so many different opportunities out there. So if you do have a client that wants information on DSTs, I'm happy to connect you with someone that can speak to them that has a securities license in your area. But a neat way to start talking about, again, setting up the exchange on both sides. Well, what are your goals? Well, I don't want to list. Well, why not? Well, I don't want to buy and be a landlord again. Well, have you heard of this? So another good talking point and a pitfall to avoid, and that pushback and not listing with you. Second to last pitfall is engaging in related party transactions. So I'll give an example of a related party and what actually happened. My dad, Mike, and my mom, Sandy, bought a condo in Oceanside, California. When I was in my early 20s, I rented that condo from them. It was their investment. My plan was to buy that condo, and I wanted to live there as my primary residence. It was gorgeous. I was very excited and I wanted to buy it, and we decided we were going to cut a deal. My dad wanted to cash out of that property. So we were setting up the deal and realized at that point, and how I got into 1031s as part of it, you cannot receive funds as a related party transaction without creating a red flag in a 1031 exchange. So I could not buy from my dad and mother and her take the cash and him take the cash and have it not be a consequence, because they can gift me inheritance money every year tax-free. That's the principle behind it. Theoretically, if I would have bought that condo and they were to exchange out where there's no funds over $50,000 being handled in that transaction, that does work. This happens a lot in SoCal. We have a lot of grandfathered property that we own for different generations, people wanting to buy and sell from each other in ownership. So again, the goal in the 1031 exchange for related parties is nobody ends up with cash. You can do the exchanges, but nobody can end up with money. And the last pitfall is not understanding a reverse exchange. I have actually quite a few right now going. We tend to do less of these as the delayed exchange is more favorable because people want to get the money from the listing into the replacement, and sometimes they don't have liquidity to outright buy a new property first. Excuse me. Hour of talking. Sorry. So in a reverse exchange, The exchanger would acquire the replacement property first. How do they do that? One, they have enough cash, of course, or two, they have a combination of financing and a down payment, right? So you find them a replacement property first. They know they have a few investments they could sell. So they acquire the replacement property. And what we do is work with our EAT, Exchange Accommodation Title Holder. Through that system, we create an LLC that's parked on title. All right. They park on title through a different contract that we use for parking arrangements. And at close of escrow, that begins their timeline, right? Close of escrow is still day 0, but now they have 180 days to sell the relinquished property, the one that they already own. When they sell that relinquished property, the sale proceeds are wired over to their qualified intermediary, to that segregated account, and then dispersed out directly to the taxpayer. So they're fronting the cash over here, waiting to sell the other property. Now, what happens if they can't sell the other property in 180 days? Well, now they own 2 properties and they're not doing an exchange from the relinquished to the replacement. However, they can take their relinquished, their other asset they already own, and exchange into a different property. So this is very advantageous for maybe that one property that comes up in that one area that someone wants to buy, but they haven't sold or listed their other properties yet. It gives them 6 months to do so, that 180 calendar days. An improvement exchange would be maybe someone sells a relinquished property in the delayed exchange format that we've been covering today. The sale proceeds go from the relinquished into a segregated account with the qualified intermediary. They find replacement property, and we'll use that example where it was $700,000, and maybe it needs improvements of up to 300 grand, but we're holding $1 million. I'm holding $1 million, that means I have 300 grand left over in this exchange. What we would do at closing of the replacement is place that LLC parked on title again through the EAT to hold the replacement on title while they draw on those funds in that segregated account to improve the property. Now, the kicker here is they must identify what's to be improved on their identification form in that 45 days, or at least substantially completed, and it must be completed within 180 days. At that time, the property is then either assigned the LLC to the client, or they can re-record in their name. So it's kind of a neat way to use the excess proceeds to improve the property. Now, we know a lot different codes and permits take some time in SoCal. So depending on what the improvement is, it must be to real property. It cannot be furniture, that's personal property, right? It cannot be anything that's movable on that space. So actually enhancing the structure improvements to the land or the dwelling. A built-to-suit exchange, or built-to-suit, either way. What you're doing is using exchange proceeds, finding replacement property, maybe it's land, and you're actually doing the same principle as the improvement, but you're drawing on the proceeds to build it from the ground up. So same concept. Again, you need permitting, coding way ahead of time, depending on the county. The last one isn't used that frequently in California for those reasons. It takes a lot of time to get those permits. But these are options that are available for the client. So they have an option when you're exchanging if something amazing comes up as an opportunity to improve, to build, or to buy first. So WIFM, I always say everyone has a WIFM on their forehead. What's in it for me, right? The goal from this is to understand what not to do, the pitfalls, while absorbing the positives to do. Part of that is just trying to be the resource. I like to call my agents who do a lot of exchanges the exchange agent. You earn a lot of trust from investors, and they are repeat deals, right? So you understand what's required now for full tax deferral. You can talk the talk, walk the walk like an investor. And talking numbers, because very clearly I'm a numbers girl. When you farm 100 investors, average sale for investment property is 5 years. We do that math, 100 divided by 5, that's about 20 sales every year. That's 20 relinquished property potential for you with the opportunity of 20 replacements. Now, again, we talked about the diversification option. They don't just have to buy 1 replacement. They could buy 2, they could buy 3. So there's a very, very positive formula here to start building success as you nurture those investment farming areas. Highlights as we wrap up is to always consult with an experienced QI and tax advisor prior to closing on that relinquished property for your client. Ensure that the sale contract is assignable, right? We talked about the cooperation clause and that we have that assignment that will be signed by the opposing transaction party. The 1031 exchange cooperation clause should establish the intent to perform and release any liabilities for the other party. We know that we have to reinvest the net exchange proceeds and acquire a property with the same or greater debt for full tax deferral. But retaining the idea of the partial exchange is crucial. Remember, it isn't all or nothing. You can also go down in value and pay taxes on the difference. Partial exchange structure. The taxpayer must formally identify in writing to the qualified intermediary the properties they intend to acquire within that 45 calendar day window, right? And last, the taxpayer must close on the replacement property by the 180th calendar day for their tax filing date, whichever is earlier. So I really, really appreciate your time. I breezed through that. I apologize for my scratchy throat. If you guys have any questions, now is the time. Please raise your hand or even type it in the chat. My cell phone number is up there too. If you feel more comfortable just having a one-on-one call, give me a call. I'm available. I think this was scheduled for 2 hours, but I usually wrap them up about this time. So there is a little bit more cushion in my schedule, and I'd love to connect. But either way, thank you all for being here. Thank you, Elsie, and have a great day. I don't see any questions, so thanks, Elsie. Bye.